Okay, good afternoon and welcome to the New Capital webinar 2023 review and 2024 outlook. I'm Catherine Barr, the Director of Communications at New Capital. And I see a number of you have already gotten started. To begin today, we're going to ask you to answer a quick poll about 4 questions and should just take you a few seconds. So as we're waiting on everyone to join us here, we'd ask you to answer those questions, and then Leonard's going to go over the results of the questions during the presentation today. So go ahead and click that and submit your answers, and we would appreciate it. Okay, and to get us started, I'm going to read the following regulatory disclosures. Okay. This New Capital presentation is being made available for educational purposes only and should not be used for any other purpose. The information presented does not constitute and should not be construed as an offering of advisory services or an offer to sell or solicitation to buy any securities, related financial instruments, financial services, or other services in any jurisdiction. Past investment performance is not an indication of future results. Wherever there is the potential for profit, there is also the possibility of loss. Certain information contained herein concerning economic trends and performance is based on or derived from information provided by independent third-party sources. New Capital believes that the sources from which such information have been obtained are reliable. However, we cannot guarantee the accuracy of such information and have not independently audited these sources. Okay, thank you. And Leonard can join us whenever you're ready.
Okay, everybody, good afternoon. Thank you for spending your lunch hour. Catherine, thank you, as always, for getting us up to the starting line for these webinars. These are always a unique opportunity for us to be with you and share thoughts with you about a variety of things. And again, thank you for working on this poll. And I'm going to go through these reminders, and when I'm done with the reminders, I'll go through the poll answers and give you the answers. So first, annual and quarterly reports are available on ncm360.com. If you want to look at the reports and don't know how to get to ncm360.com, Catherine is your person. She spends quite a bit of time each year working with people to get them access if they don't have it. Second, we have a unique opportunity on February the 7th. You should have gotten an invitation from 5:30 to 7:30 is a documentary. Some of you may have seen the work of Errol Morris, one of the great documentary filmmakers working today. He made movies like The Fog of War, which was about Defense Secretary Robert McNamara, who was the Secretary of Defense during the Vietnam War. And it was a movie that interviewed him about that war and his participation in it. He made a movie early called The Thin Blue Line that was a murder case that had great acclaim and is an excellent movie. If you haven't seen The Thin Blue Line, it must be 40 years old or so, but well worth it. And he has made a movie called Tune Out the Noise about the early days of what we would call index fund investing. And of course, Dimensional Fund Advisors, a company that we work very closely with, is a company whose principals were very intimately involved and were participants in the early days of the creation of index funds. And this is a movie about those people in those days. It's going to be at the iPic Cinema at River Oaks. The movie will start at 6 p.m. And so you need to get there, get your seat, and they're going to serve like a dinner entree and drinks. And it's a nice opportunity for us all to come together and watch this documentary, which is not out in general release yet. So this is the only way that you can see it, is through this kind of exclusive screening. We probably had about 10 people sign up for it, and if you're interested, please do. But do sign up for it. Don't wait, because we do need to get an accurate head count. Third, this is, I can't believe it, but it's true, New Capital's 20th anniversary this year. I started the company in June of 2004, and June of 2024 is coming up. And Catherine and I are in the early stages of planning some reception. We're going to have it. It's probably going to be at a local restaurant that's got a good room and good food, and we need to figure out what that is. If you have some suggestions, if you know a good venue that you like and have had a good experience with, send us a note or a chat even during this presentation today, because we're starting work on that, and you'll get an invitation to it when it's ready. But hopefully that'll be in the next couple months, and we'll look forward to having everybody to that as well. It's been a wonderful 20 years, and look forward to being with everybody to celebrate that. Okay. Best performing stock among this list. Now, this list is not asking you what was the best performing stock in the United States or the best performing stock in the world, because I didn't give that to you here. There are reasons for that. There are biotech stocks that will go up 3,000%, but they're very, very thinly traded. And every day you'll see stocks go up some crazy amount, 50% in a day, or lose 50% in a day. So I gave some companies that have some liquidity, some float in their shares, and some following. And the answer of the best performing of this selection, and believe me, these all performed extremely well, was Carvana, the last one. Most of you, not most of you, but a plurality of you picked NVIDIA for good reason. It was the darling stock of last year with its chip-making capabilities for AI. Coinbase actually outperformed NVIDIA. Coinbase had a very big year, a lot of gains coming at the end of the year. Coinbase, which is a trading and brokerage platform for cryptocurrency, and now that we have just approved by the SEC exchange ETFs, exchange traded funds that do hold Bitcoin in their funds, and I'll talk about that, what we're thinking about with regard to that. Some of those companies have their custody with Coinbase. Coinbase had a big year, up about 300%, actually outperformed NVIDIA. Meta, which is Facebook, had a big year. DraftKings, I don't do fantasy football, but apparently that's what they do. But Carvana was the answer, and by a long shot, 1,000%. And it's notable because Carvana was a terrible stock. I don't know, I want to say 2 years ago, completely fell apart and may have been on the verge of bankruptcy. And you see this pretty often, that something falls hard and it may recover. What's interesting, I want everybody to think about, though, is that let's think about a stock that gets cut in half. If a stock gets a 50% loss, okay, so if it goes from $2 to $1, what does it have to do to get back to its original $1? What return does it have to have? Think about that. What is it? If something goes from $2 to $1, that's a 50% loss. For it to go from $1 back to $2 to get back to where it was, it has to have a 100% return. This is one of the interesting, fascinating things about mathematics and the mathematics of returns, is that if you get a big loss, like a 50% loss, you have to have an even bigger gain to get back to where you were. And why is that important for 2023? Because 2022 was disastrous for a lot of these stocks. And so people are thinking, oh, NVIDIA and Meta, they had these huge years. But if you put 2022 together with 2023, what you'll find is that more or less, a lot of these stocks that had a big 2023 were just getting back to where they were at the beginning of 2022. Because of the example I just gave you. If you have a 50% loss in something, to get back to where it was, it has to have a 100% gain. And many of these stocks actually did not get back to where they were at the beginning of 2022. So this is why you have to put big gains like this in perspective. Okay, Next question, which of the country stock markets was the best? 12 out of 18, 67% of you picked the United States, but that's not even close. Greece, Poland, and Hungary, all three of those, the first three, all had returns around the same. They were all around 50%, roughly double what the US market did. And the one that actually performed the best was Hungary, who may be best known for its Donald Trump-like leader, Viktor Orban. It had the best performing stock market, not by a lot. Poland, I think, was second, and Greece was third. Greece, you may remember, was an economic basket case about 10 years ago. I had the pleasure of visiting the country 2 years ago, or 2.5 years ago, and found it to be amazing, incredible, and delightful. And of course, it's also the birthplace of democracy. And it had a fantastic year. And your portfolios participated in all of that, Greece, Poland, and Hungary, because we give you a globally diversified portfolio. I put in Hong Kong. Two of you picked Hong Kong. Hong Kong was the worst performing stock market of any country last year. So I got you on. I got you, a couple of you. The Chinese stock market is having some problems now, and that's translated into the Hong Kong stock market, which is a proxy for the Chinese stock market. Lots of Chinese companies trade on the Hong Kong stock market. And as a matter of fact, just yesterday, I think, or the day before Monday, India, the country of India, its stock market valuation passed Hong Kong. India has been growing very, very rapidly and is having a lot of good success economically. The United States had a fantastic year with most of the gains, or at least half the gains, coming in the fourth quarter alone. The S&P 500 returned about 12% through Q3, and then it returned about another 12% or so in Q4. And so half of the gains came in the last quarter alone. And that was in reaction to the market's sense that the Federal Reserve, which I'll talk about, had stopped its increases in interest rates and was going to likely embark on some decreases. All right, number three, by approximately how much did a global 50-50 portfolio outperform cash in 2023? So in other words, a portfolio composed of 50% global stocks and 50% global bonds, how much did it outperform cash? A plurality of you picked 5%, not a bad guess. A good amount of you, second selection, was 12%. A few of you picked 2 and 3%. The answer is 9%. So the 50-50 global portfolio did about 14-15%, and cash did about 5%. Why is that important? Well, because everybody, not everybody, but a lot of people, including clients we've talked to, have been in love with CDs and money markets and so on. But if you put all your money into that, you got 1/3 of the return that you would have gotten from a simple 50-50 stock bond allocation. And so we have to be careful about anchoring. We've been anchored at interest rates on cash at 1% or even lower, almost 0%. Suddenly it's 5%, and you're happy with that. But the U.S. stock market did 24%, and so your cash got whooped in comparison to that. And I have a slide I'll show you about this a little bit later. Finally, who will be the next U.S. president? 86% of you think it will be Joe Biden. Only 2 of you, 14% of those who took the poll, think it will be Donald Trump. And of course, last night was the New Hampshire primary, where Donald Trump triumphed in the New Hampshire primary. But I think if you look deeply at the results, dear President Trump has some problems. He has quite a number of Republicans of conscience who refuse to pull the lever for him, and he has a remaining opponent in the primaries who is indicating that she is not going to get out of the race. And I don't blame her. I don't think she should get out of the race. I think she should take it all the way to the convention And I think that makes all the sense in the world. She had a very respectable showing. I know a lot of people are saying, well, that was her chance to win. Um, but we'll see. Lots of things can happen. Lots of things can change. 86% of you think that Joe Biden will win. I think there's probably quite a bit of survey bias among New Capital clients. And we may ask this question throughout the year at the other webinars. Okay, so let's see. I stopped sharing the poll. All right. I sent out a memo along with reports. We have some benchmark changes. These are not like major, massive changes, but I always want to mention them. We are changing our stock benchmark from a Morningstar benchmark to an MSCI benchmark called the MSCI All Country World Index. It's just a more commonly followed index. MSCI, I think, is a kind of a bigger provider. The Morningstar Index, perfectly fine and did fine for us over the years. But we making that change. And we also are making a change in our bond index so that it's more, rather than the aggregate US bond index, we are now using the aggregate global bond index, because over the last year we have made changes to our portfolio to also include bonds that are held outside the United States. And that was good last year because actually international bonds did better than US bonds last year, although international stocks did not do as well as US stocks. So it was kind of weird. International bonds did better than US bonds. International stocks didn't do as well as US stocks. But it was a good year for everything, all the same. We have some reporting changes. We made some enhancements to our report. We are reporting our main report, our performance summary, to you now. We're giving you both your returns gross of our fees, so the returns before our fees, and the returns after our fees. And then we did some other kind of aesthetic changes and just did some work on the report at the end of the year to make it better. And I want to thank JC Smalley very much for her work on that. JC did a lot of work to get under the hood of the programming of the reports, and I'm really happy with how they look. And then another thing we are considering, JC and I, that is, we haven't come to any conclusion yet, but we may issue some more model portfolios later this year. It might be end of Q1 or Q2, we'll see, where we'll have a US only set of models and an ex-US only set of models. And that would allow clients, if they wanted to, you could say to us, well, I want to make my own custom blend of US versus international. Or you could do that with some of your money. So with some of your money, you could say we want New Capital's model portfolio, which is our kind of best thinking portfolio. When you could say with some other money, I want to make this blend or whatever. So it would give some other flexibility, and we're looking at doing that. And I'd say the likelihood is that we will. No final announcement on that right here, but just to let you know that we're chewing on that. Okay. Election year 2024. I want to talk to you about what we are doing and what we can do, because I have already begun to get from clients some emails and some questions that I would characterize as quote, the political process in the United States is a terrible mess. I am very concerned and worried. What are you doing to protect my money? End quote. I guess that's how I would put it. And I've gotten a few of these. I wouldn't say I'm being swamped or inundated, but it's enough to make me think that even if people are not sending me emails, that they may be thinking or wondering about it. And here we are in what looks like is going to be the longest general election campaign in US history. And so here on January the 24th, let me talk about this. First of all, our standard portfolios, as you know, are globally diversified. And so that's where it starts. We do not have 100% of your money invested in the United States. We have a lot of your money invested in the United States. We have most of your money invested in the United States, meaning a majority. And if you don't like that or want that, we can discuss that. And my discussion just a moment ago about a US only model portfolio, set of model portfolios, and an ex-US only set of model portfolios would allow you to do something more customized if you want to do that. But you are already highly internationally diversified, and we are more internationally diversified by a bit. I wouldn't, not by a ton, but more than I would say our partners, Vanguard, Dimensional, BlackRock. They tend to tilt more US. You are mostly US. Your bond portfolio is heavily US to the tune of about 80%, and your stock portfolios are US to the tune of about 55-45. So you are mostly, when you put all that together, you're mostly invested in the United States. Add in your house and your jobs. You are highly tied to the United States, and so we can only do so much to cut your exposure to life in the United States if that is something that you want. And by the way, while most of our clients are Democrats, we do have clients who are Republicans, and if Joe Biden's reelected, you may feel like you're not happy. So this goes for anybody. Nobody, no one. We're not going to be able to make everybody happy in the election of 2024 by far. And presumably those who don't get their way are going to be very, very unhappy. So we already begin with a very strong helping of international diversification. Second, as most of you know, we have the ability to offer you international custody in Switzerland. We have a few clients who have done that program. It's not free. They have a $3,000 a year minimum. They do not take IRA accounts, not because they don't want to, but because they're not approved to be an IRA custodian. That's a very specific United States program under U.S. Department of Labor and ERISA law. And so foreign banks are just not set up to handle IRAs. But if you have a substantial, regular, non-qualified account, we can establish for you custody there. Do you need it? Whoever wins the election, I don't think that's going to affect Fidelity, Schwab, or any of the custodians at all. But if you felt like you wanted to keep money or have the ability to keep money just outside the United States, just because you want to keep money out of the United States, we can arrange for that. Third, we can do financial planning with you focused on residency. If you think at the end of the election that you want to take a break from being here, not by changing your citizenship, but by you just need to go somewhere, we can do financial planning with you and see what the cost of that would be and how that fits into your financial plan. And if you wanted to go even further than that and seek alternative citizenship, we can help with that also. We would work on both of these with a company called Henley and Associates that I've had several conversations with over the years. They are the top specialists in global residency, global alternative residency, and alternative citizenship planning, and they do legal work and application work toward that. So those are the third and the fourth things. Fifth thing, I think it's very important that if you feel very strongly about the election year 2024 in politics, that you do what you can with political contributions. And that doesn't have to be only money. It can be your time, your energy. But whatever it is, it should be something so that if you get a result that you're not happy with, it isn't a situation where you haven't done anything to help bring about or haven't done much to bring about a different result than the one you wanted. And I've encouraged several clients to give even small amounts of money to campaigns that are important to them or ones they find. I haven't made any recommendations. It's your choice. I myself have been making political contributions on a regular monthly basis to several campaigns that I think are important, because I don't ever want I always want to be able to tell my children, either we got this result and I was a part of it, or we got this result and I did what I could, or I did something. And so I want everybody to think very, very carefully about that. Don't just complain. By definition, new capital clients have money and skills and education. That's what higher net worth wealth management business, that's who our customers and clients are, like you. And I would encourage you to dig a little deep on what you can do to help. Organizations need your expertise, they need your time, and of course they need your money. Money is literally the currency in the political world in the United States, and none of us are going to change that by wishing it away. It's just not going to happen. And finally, number 6, I want everybody to recognize that markets, stock markets especially, the U.S. stock market especially, is at an all-time high. We've had a series of a succession of new highs achieved, I think, even this week. And the market looks ahead. The market is well aware of who is likely to be running for president. The market even probably is making an educated guess as to what is likely to happen in the elections at all levels, and what the effect on the country will be. And this is where we are. I don't interpret what it means. It doesn't mean that the market is telling us who's going to win or what the results are going to be. But what the market is saying is that right now the market does not see a result which is going to be adverse to your wealth, for whatever that's worth. That is what the market is saying. Otherwise, we would wake up today and values would have been cut in half, right? But that's not what we're seeing. And so there's a lot of information we get simply from levels in the market themselves. And what we have right now are all-time highs in the U.S. stock market. And if the market saw all kinds of trouble out ahead, it would tell us. So that's my discussion about election year 2024. I'll have more to say about it. Let me say that's the last thing I want to say. We will, of course, be monitoring events in the election year as they go on, and we'll be making comments, adjustments as appropriate. Some of you, maybe all of you, know that Bitcoin is now trading, was approved by the Securities and Exchange Commission after a very long application process that took many years. And in fact, the SEC was taken to court because what existed before the Bitcoin spot ETFs were funds that had been put together to give people exposure to Bitcoin, but because they traded in Bitcoin or other cryptocurrency futures contracts, that is what they were buying, futures contracts, there was divergence between the performance of the cryptocurrency that was the underlying asset and the futures contract on that underlying asset. And so the funds were performing wonky. Sometimes they'd be way above what the spot price for the cryptocurrency was, sometimes way below and trading at a big discount. And so really, as professional advisors, we couldn't really recommend that kind of security to clients. But the SEC finally, and they lost a case just a few weeks ago, approved spot Bitcoin ETF. So these are funds that hold within the funds Bitcoin. So the funds take custody of Bitcoin and they store it. And if you own a share in it, then you own a share of the vault. And this was pioneered probably 20 years ago when we had commodity ETFs that were coming about, gold commodity ETFs and silver and so on. And those things are now 20 years old and have done fine. I'm not a big buyer of precious metals, but this is sort of where this thing was pioneered, where The gold is stored in a vault somewhere safely. You don't have to worry about storing gold. You don't have to worry about putting burglar alarms all over your house and safe deposit box to keep it safe, because if it gets stolen, you're out of luck. You can simply buy a share of the gold ETF. Same thing here, no difference. There are now digital vaults that BlackRock is responsible for, or Eaton Vance is in this business now. They're responsible for. Vanguard, by the way, has chosen not to get into this business and has said, we will not. We do not believe in Bitcoin for our clients. It's nothing we want to make available. And so there's still controversy about it, although it had a huge year last year, up 100% plus, 150% or so. So big year for Bitcoin last year, after it had fallen in price by 75%, right? So even though it was up 150% last year, it still is not close to its all-time high, which was around $70,000. It's around $40,000. So going back to my prior comments, if something gets whacked down hard, 50, 75%, it's going to take a lot more than 100, 150% to get it back to where it was. It may take 300%. So Bitcoin had a big year last year, but if you were a buyer of it at 60,000 or 70,000 a Bitcoin, you still have a 33% loss in it. Anyway, if we do anything here, and I'm just beginning my evaluation, and I've studied whether it belongs in a portfolio, it'll probably look like something like this. We will probably use the IBIT fund because of our relationship with BlackRock and iShares. It is the cheapest fund along with the one offered by Fidelity. And they're actually giving, all these funds are giving, not all of them, but most of them are giving some deal where no fees for the first 6 months. They're trying to get people interested in it. This one's 25 basis points. Most of the funds we buy for you are less than 25 basis points now, but it's fine. It's not a hugely high fee, and it's a low fee. We might consider it for our model portfolio, but it would be in a low allocation. And the reason is the volatility of Bitcoin is 4 times the volatility of the US stock market. 4 times. It's hugely, hugely, hugely volatile. So if we put a bunch of that into your portfolio, boy, your portfolio would bounce around in a way that you would more than likely complain to me about if it bounced on the downside. And there is a history of cryptocurrency collapsing in price and then rising rapidly in price and then collapsing in price. And then the cycle repeats. And so so it would be a small bit of chili powder in the chili, but no decision on that either. Here's how our models performed in 2023, all the way from model 0, which is an all bond portfolio. We did right in line with the Barclays Global Aggregate Benchmark. And so you see, if you held all bonds, I don't know that we even have any clients who hold 100% bonds. We have some clients who hold these more conservative allocations, perfectly fine. It's the right portfolio for them. And you can see 7%, 8%, 9%. It's a pretty good return. I don't think it's anything to sneeze at. And if you held a 100% bond portfolio, you got 5.7%, about 0.7% more than cash returns, but not a lot more, but a perfectly respectable return, all the way up to almost 19%, 18.7% for a 100 stock portfolio. We lagged our benchmark on the stock side just because we include a bit more international and we tilt a bit more toward value than the benchmarks. And I'll be talking about that because last year was another growth year, and I'm going to a year for growth stocks, and I'm going to get into that in just a second, show you to the extent of how much it was. Okay, so this is the S&P 500. I always show this, and you can see that last year the S&P 500 is up 24%. Here it is. This is the bar for 2023, but at one point last year the market was down 10%. I always like to show this slide to everybody to show that even in an up year, there may be a period in the year when the market's down. It's not like the year started and the market just rose and rose and rose and rose. At some point, the market was down 10%. So that's the picture for last year. And you can see this almost every single year, even years, and most of them are positive, dating back to 1980. There are some down years, especially 2008. Even during these up years, almost every year, there was a period, all these red dots, when the market had a down period. So if you cannot take any down in the stock market, you can't invest in the stock market. This was a year, 2023, the year just passed, of the Magnificent Seven: Microsoft, Apple, Nvidia, Amazon, Alphabet, Meta, and Tesla. What were coined last year as the Magnificent Seven, and you can see their contribution to the index return. Each of these had very large contribution. So Microsoft had a 2.75% contribution to the Russell 3000. The Russell 3000 returned about 24%. So Microsoft's contribution was about 10% of the return, 10% of the return to the entire Russell 3000 index came from one company, Microsoft. So the returns last year were highly concentrated in these 7 stocks, and I'm going to show you several slides to show you what that means, while my pool guy goes behind me to to clean the pool. So I'm at home this morning. All right, so let's see what that means. Well, here is the MSCI All Country World Index. That's our new benchmark for global stocks as of December 31st. Here is the weight of the United States in that index. 62% of all stocks in the MSCI All Country World are in the US. 17% of the entire MSCI World Index are in these Magnificent Seven stocks. 17% of the entire world stock market is in those 7 stocks, which is approximately equal to the entire stock markets of Japan, the United Kingdom, France, Canada, and China. In other words, if you put all the companies together, Toyota Motor, and I don't know, LVMH, Moet Hennessy, and Royal Bank of Canada, and China, Tencent, all of the companies in these countries together are approximately equal to the Magnificent Seven. Amazing, isn't it? Now, I'll remind you that in 2022, these stocks had a much rougher year. And so they had a big year last year, but now you know that if you put 2022 together with 2023, those 2 years together were about equal. All right, so that's one look at the concentration and the impact of these Magnificent Seven. This slide is showing you the return of the US market, and I don't know what I used here. I'm guessing Russell 3000 or something. 26% was the return last year of the US market. If you take out the Magnificent Seven, look at what the return does. It drops to 15.7. Now, that's still a very, very good return. I'll take that any year. But the addition of just those 7 companies gave returns of an additional 10%. Now, here is the global market without the United States. Okay, so this is international stocks, no US stocks contained in this right-hand graph. The return to that market was 15.6%. Again, nothing to sneeze at, a 15% return. Most people take that any day. If you take out the top 7 contributors to the returns in those markets, I don't know what they are. Let's just say it's Toyota Motor and Royal Dutch Shell and LVMH and Fiat, or and so on. I don't know what the top 7 contributors to these returns are. You see that those top 7 contributors only are contributing a small amount between the 14.3 without those 7 and 15.6. So the US is heavily reliant on those 7 companies. Now, this is to show you and give you a look at, well, can it continue? And the answer is, I don't know. I do know that the more expensive something gets, the less likely it is that it's going to produce the same outsized returns in the future. And all things equal, when the price of something goes up, the return goes down. And conversely, when the price of something goes down, all things equal, meaning if their earnings haven't changed and their revenue prospects haven't changed, and competitive situation hasn't changed, all things equal, if the price goes down, then the return goes up. So I've shown this before, but I really can't show it enough. This goes back to 1927, everybody. All right, so this is not 10 years of data and 5 years of data. This is almost 100 years of data in the US stock market going back to 1927. All right, so this encompasses years when the big company on the block, the big man on the block was IBM in the 1960s, and General Motors, and Sears going back earlier, and so on, right? 100 years of US companies. And look at this. This is time zero. This is the start of the first calendar year when the company appears in the top 10. All right, so think of this as year zero. The year the company arrives in the top 10 of the stock market. And looking back, the analysis shows that 3 years before, the companies that appeared in the top 10, on average, gave 27% returns a year, each year in the 3 years before they entered the top 10. That makes sense, right? Their pace accelerated as they broke into the top 10. 5 years before they broke into the top 10, their average annual return, each year, was 20.3% each year in the 5 years before they broke into the top 10. And if you go back 10 years before, then the average return was 12.1% a year on average before and each year subsequent to the 10th year, 9th year, 8th year. So if you count it down, 10, 9, 8, 7, 6, 5, 4, 3, 2, 1 into the top 10, the average return of all those years was 12.1%. Nothing is, fantastic. And you see that the returns accelerated. But look what happens after they break into the top 10. Again, this is almost 100 years of data. Maybe this Magnificent Seven is going to break the cycle and we're going to get something new because it's different this time. I have no idea. Can't tell you what's going to happen. But this is just giving you what happened, what has happened with the IBMs and the General Motors and the Exxons and the, Philip Morris, the biggest companies that nobody thought could, would never, ever do anything except put up these kind of returns. Well, you can see 3 years, in the 3 years after, 3, 2, 1 going forward, 5 years, 5, 4, 3, 2, 1, 10 years, 10, 9, 8, 7, 6, 5, 4, 3, 2, 1. All these return, you see their returns are basically negative. And by the way, I should add, this is versus the benchmark. This is versus the market. Okay, so this is in comparison to the market. So basically, they were earning a little bit less than market returns. So I want everybody to understand that this has been the history of what happens when you get these ragingly hot stocks. This is a look at the diversification of the top 10. So if you look at the NASDAQ, which had an incredible year last year, up almost 50%. NASDAQ, by the way, is a stock exchange begun around 1970, 72 or so, one of the first electronic trading floors. And it's very tech heavy. And you can see that the top 10 holdings in the NASDAQ QQQ ETF, 50% is what they account for. 10 holdings, the top 10 account for half of the fund. Well, in a year like last year, when the top 10 holdings were on fire, fantastic. But the year before, in 2022, when the top 10 holdings were all wet, it had a tough year because much less diversified. The next line shows you the S&P 500, more diversified, but you can still see that the top 10 holdings from 2014, when the top 10 holdings were under 20%, look at the change in the S&P 500 today. The top 10 stocks account for 1/3 of the S&P 500. So you have enormous concentration occurring in a 500 stock index like the S&P 500, and incredible lack of diversification in a 100, which is what the NASDAQ QQQ is, 100 stocks, NASDAQ 100. The funds we hold for you are more like this. And in fact, this shows you the funds we hold for you, where those top 10 stocks are present for sure. This is the US core equity portfolio we hold for you. Back in 2014, those top 10 stocks accounted for, call it 12%. And they're nothing to sneeze at right now. Here in 2024, they account for 20%. So the top 10 holdings account for 20% of the US fund that we like to hold for you because of its diversification. But this fund is more like 3,000 stocks. This is 500 stocks and 100 stocks. And so this is by design. We're giving you a diversification so that if we get a real problem with any one company, it doesn't impact you. And then the same thing here in this international portfolio. So I think this slide does a really good job of showing you the impact of diversification and the exposure. And I know in a year like 2023, this is what you want. I get it. I understand that. But there's downside too. And we'll look at valuations and see what could be in store for us valuation-wise. This kind of shows the same thing. So here's the S&P 500 index. It holds 500 stocks over the NASDAQ. It gives you Apple, Microsoft, Alphabet. The Russell 3000 adds a bunch of other U.S. companies. So now it's 3,000 U.S. companies. And that adds companies like Workday and Atlassian and CrowdStrike. The MSCI World Index, IMI, which is developed countries, has 5,657 companies and adds companies like Novo Nordisk, Nestle, ASML. These are not shabby companies. And our view at New Capital is, well, why wouldn't you want to own stock in Novo Nordisk, Nestle, and ASML, right? Perfectly good, excellent, phenomenal companies. So we let you have ownership in it. I'm not going to keep you from ownership in these terrific companies. And then same thing here, IMI expands it to some emerging market countries, 9,000. This is the MSCI All Country World IMI Index, and we add Taiwan Semiconductor, Samsung, Tencent Holdings, and that. And so this is just a slide to show you the impact of diversification and giving you an example of some companies that you're getting when we add that diversification. And I would rather give you ownership in those companies than not give you ownership in those companies. All right, S&P 500. And by the way, today we're going to go to 130. I knew we were going to need a longer time frame today, and it's just the way it is. Where are we on valuation? Well, the S&P 500 as of January 18th, just a few days ago, almost 20 times earnings. All right. So we're up from where we hit in October of 2022, the trough, the most recent trough, when the index was trading at 15.7 times earnings. So we have gone up very significantly. That's a 33% increase in the forward multiple of the S&P 500 after the recent run that we've gone on. And so that's where we are. And the dividend yield is 1.5%. And the 10-year Treasury notably is now at 4.1%. So this is important because back in these days, look back in 2020 when the index was trading at 19.2. If you said, well, that's too rich for me. Or here in January of 2022, again, 21.4 times earnings, you said, that's too rich for me. That implies a 5% return on the S&P 500, right? 1 divided by 20 implies a 5% return. And you said a 5% return just doesn't seem good enough to me to hold stocks. Well, you had nowhere to go. Here's the 10-year Treasury, 1.6%, 1.6%. It's not like sell my stocks and buy me some bonds, but look right now. Suddenly, you have a 5% implied return on the S&P 500 because 1/20 is a 5% implied return. Now, the earnings could grow. This is a forward, but it's a forward return we're showing you. This is not trailing return. This is future return, a forward return. If you say it's too rich for me, you could say I'll hold a 10-year Treasury bond's going to get me almost the 5% that this is implying for a return in a risk-free 10-year Treasury bond. I'm not saying to run out and do it. I'm just saying we're in a completely different environment trading at 20 times earnings than we were in 2020 and 2022. And of course, the difference is the opportunity cost that we're comparing to with the 10-year Treasury bond. This gives you a look at valuation as well, the forward price to earnings ratio, meaning looking forward at what analysts are projecting earnings to be in the future. And here's the 19.5. You can see, well, how expensive is that? Well, you see that this is the average over 30 years for the S&P 500, 16.6. And we are one standard deviation above the average. That's a measure of the expensiveness of the US market, right? And we've had higher levels, including very recently, we had higher levels, including 22 times earnings back here in 2021. Right? Before all this came down in 2022, we had this big sudden drop right here during COVID, and we were buyers right here back in March of 2020. We were buying stocks for you right here. All right. And this was at the end of 2022, December 2022. I told everybody I was pretty hopeful about 2023. I said, I think we'll maybe see 10% returns or so. And, that turned out to be right, but less than right? Returns were much higher than that. But I thought here, and so valuation matters. This is where we are right now. It's not the most expensive we've ever been, and not the most expensive we've been recently. This is the most expensive we've been recently, almost 2 standard deviations expensive. This is the most expensive we've ever been. Look at that tech bubble in 2000. This was the internet craze. And look where we hit, 2 standard deviations expensive. This was WorldCom and Enron and Dell Computer and Cisco Systems. And a lot of people got really just destroyed. The NASDAQ stock market by the end of this right here was down 80%. People lost 4/5 of their money. I can't let that happen to my clients. You'll fire me. I don't want to get fired. I don't like getting fired. So whenever valuations get elevated, I have to be a little cautious about it, okay? So not the most expensive we've ever been. That's here, right? When I say ever, I mean the last 40 years or so. And not the most expensive recently, but it's a little frothy. You can see this. I always debate whether to show this slide. There's so much going on, and it's like, where do I draw your attention to? It's just kind of too many numbers. I kind of always like to just drop down here and show you what is the percent valuation. And this is showing you large, medium, and small cap companies and value, blend, and growth companies. So the NVIDIAs of the world here, and the the Exxon Mobils of the world here, and the Coca-Colas of the world here in the blend. And you can see that this large cap growth area that includes the Microsofts and the Apples and so on is trading at 141% of its 20-year average price to earnings ratio, versus small companies that are value companies trading at 93% of their 20-year average. So nothing is a screaming buy right now in the US stock market. But the reason we give you a diversification, we give you all these squares. We give you this. Don't think we don't give you this. We give you this. We just don't overdose on it. And we don't overdose on this, and we don't overdose on this. We give you all of this, right? Maybe this is going to continue to go strong. Fine, you'll participate in it. Maybe it's going to sell off. Fine, you won't get killed because you'll own some of this other. So I think that's all I want to say about this slide. I don't want to run too long on time, and we've got about 30 minutes or so left. I think I'll get through my presentation here. All right. This is a measure of, this is value and growth. And this chart is showing you when is growth expensive. That was in the line is above this dashed line. That means growth is cheap, sorry, and value is expensive. And when the line is below the dotted line, the gray line is below it, it means value is cheap in comparison to growth. And you can clearly see that for the last several years, value has been cheaper than growth. And that's where we are. And so, we continue to see the world as a growth. People are paying expensive prices for growth. We have growth in your portfolio, but I'm really not in a big hurry to run out and buy a bunch of growth for you, because what happens with growth stocks is that when growth slows, even a little bit, the stocks get trash compacted. That's what happens. The market is valuing growth stocks so much on ongoing future rapid growth that any little hiccup in that ongoing future rapid growth and the stocks get murdered. So I've seen it happen many times, many. I can't tell you how many times I've seen it happen in my career. And so I like growth stocks, nothing against growth stocks. They're in your portfolio, but in moderation, right? Just like everything. And you can see here, this is an interesting chart on the right. This shows you that when the 10-year Treasury bond has a certain interest rate. So if the interest rate on the 10-year Treasury bond, 0 to 2%, like we've experienced recently, a couple of years ago and in the years ahead of it, so low, or 2 to 3% on the 10-year US Treasury, and the 3 to 4%, 4 to 5, and greater than 5%, when that is the interest rate on the 10-year Treasury, which is the most commonly thought of risk-free interest rate. It's the interest rate to which so many things are compared in the world of finance. Well, you can see that when the interest rate on the 10-year Treasury is very low, that has favored clearly the green bars growth stocks. Big time. You can see that. And this goes back to 1979. So this is a long 40-plus year history of data in this chart. I like this chart. I think it's very revealing. But you can see that as the 10-year Treasury rate goes up, 3 to 4%, up 6 and 6, it's about equal. 4 to 5, which is where we are now, value has outperformed over this long period of time by 2%, not by this crunching amount, but it has outperformed when we see higher interest rates, and then also some outperformance as well when rates are even higher. So will it continue? I have no idea. I'm just giving you the data, and all I can make decisions upon is data. You don't want me making decisions based upon, what I think, but based upon data, and that's what we do. Now, international. I know I sound like a broken record saying international is cheap versus the US, but it's just a fact. I'll show you that in a second. What you can see here is that there are cycles of outperformance of US versus international. If we go back to 1971, there was a 2.5-year period where international outperformed the US by 80%. And then from this period, 3 years, the US outperformed international by 28%. International picked up again for a 2-year period, 89% outperformance of the US. 4.7 years, the US picked up with 60% outperformance. Look at this, 5.6 years between these years, 86 to 89. A lot of that was driven by the Japanese stock market, but it was. 5.6 years, 299% outperformance. US picks up again here. 3.9 years, 87%. International here, you get the point. By and large, the US has outperformed over this long period. But we don't know what's going to go forward. This has been a very long period of US outperformance. 14.2 years of US outperformance versus international. For a cumulative outperformance, 277%. It's very, very, very significant. And I'm well aware of it. But where does that bring us to in valuations? This is a business that's always about price. It's always been about price, and it always will be about price. But let's take a look. The 20-year average PE ratio of the S&P 500 has been 15.6. I showed you that figure before, a few slides before, on the line graph of the S&P 500. It's now at 19.5. I showed you that number. International stocks on average have been 13.1 on average over the last 20 years and are below that, 12.7. And this chart shows you the difference in discount of the price to earnings ratio of international stocks versus the US. We are now at 2 standard deviations below in valuation. It's a lot. It means that the international valuations are 35.1%, not below US valuations. It's not saying this 35.1% is below the US valuation. It's saying it's 35.1% below the average. It's more like 70% of the valuation, right, discount below the US nominal amount. So it's a tremendous, you can see that dating back to 2004, a tremendous discount for international stocks that's only gotten bigger. And it makes me look, what, stupid? I don't know, bad? But there's safety in a cheaper asset, right? There's not as far to fall if growth slows. I'm not saying growth is going to slow, but we want to continue to include international stocks in your portfolio. At the same time, if you say, I don't want international stocks, I think in a few months, we're going to have a US only set of models and an international set of models. And we can discuss what you want to do, but it's still in my portfolio. This is very cheap. Now, you may say there's a reason. The US is just better. Well, again, I don't look at it as buying stocks in countries. I look at us as buying stocks in companies, right? And so if Toyota Motor Company is super cheap and LVMH, Moet Hennessy is super cheap, and Fiat, which owns Chrysler, is super cheap, and Siemens is super cheap, I don't think about it as, oh, I'm buying cheap Japan or cheap Germany. I just think I'm buying cheap Toyota and cheap Siemens and good companies with excellent managers that are trading very, very cheaply. There's a lot of speculation about why international is trading more cheaply. It is the cover story of the Morningstar December issue, Morningstar magazine of the December issue. And, scholars are trying to think about it. What's the reason? In the meantime, I'm not a financial scholar. I'm a financial practitioner, and that's cheap. And I like cheap. I just do. Look at the difference in dividend yield. So here is a 1.8% higher dividend yield for international stocks versus US stocks, right? The dividend on international stocks is more like 3%, 3.2%. US stocks more like 1.5. So you're getting paid a higher dividend yield too. Anyway, happy to answer questions about international, but I want you to see that it's cheap. I can't tell you when the investors of the world are going to wake up and go, wait, I can get Toyota for that? But I'm pretty sure that day is going to come. All right, checking my time here. Well, I think we're good because we're going to go to 1:30. The aggregate bond index, this is bonds. We're shipping into bond land now. You can see that bonds staged a big rebound in 2023. You may remember that in 2022, it was not just stocks that had a tough year. It was bonds too. And not just They had a bad year. They had a record bad year. You can see in 2022, bonds had the worst year in their recent history, dating on this chart, dating back to 1976, but I think went well beyond that. It was a disastrous year as the Fed raised interest rates very rapidly, hit longer bonds, and we did a really good job protecting clients from losses in their bond portfolios. And then last year, since I'm reviewing 2023, you can see we had back to 6%. And there, however, was a period during that year, last year, when there was a 7% loss in the bond market at one point. So even the bond market, though the lows on an annualized basis don't approach the lows that you see in the stock market on an intra-year decline basis, they do occur. The Treasury yield curve, end of December 2021. Does everybody remember these interest rates? 0.2% on cash, 0.4%. It's hard to remember now, right? Life goes on and you forget, but look where we were at the end of 2021. These were the yields. And it was these yields, 1.9% on 20-year bonds and 1.9% on 30-year bonds, that got the likes of Silicon Valley Bank in trouble, which was a 2023 last year event. This caught up with those banks that bought these bonds at 1.9% yields back in COVID, and then the yields on these bonds went to this, which means the price of those bonds plummeted by 33%, in some cases more, 50%. And Silicon Valley Bank last year in 2023 woke up and it was bankrupt. Now, I'm going to tell you some bad news. And I told you about this in a webinar last year. Silicon Valley Bank was in many of your portfolios, probably all of your portfolios. But it was in at a teensy amount. Totally imperceptible. And that's the point of diversification. Bankruptcy is the absolutely worst thing that can happen to a company, right? If you're a shareholder. If you're a bondholder, you may survive bankruptcy. You may be able to claim the assets, or you may be able to get 70 cents on the loans that you've made. But if you are a shareholder in a company, what is the worst thing that can happen? Bankruptcy. And we have seen bankruptcy after bankruptcy. It doesn't happen every day or all the time, but Sears has gone bankrupt. Montgomery Ward has gone bankrupt. Fannie Mae has gone bankrupt. Freddie Mae has gone bankrupt. And last year, Silicon Valley Bank went bankrupt. But you did not feel it in your portfolio. None of you. Nobody woke up and was like, oh, God, I'm having a bad day. Silicon Valley, went bankrupt. That's why we diversify you. Okay, and this is where we are yield curve-wise right now. You can see here in January 18th of 2024, rates have come down from their peaks from October of last year, and bond prices have rallied and strengthened. But you can see we are still above where we were rate-wise at the end of 2022 and certainly at the end of 2021. This is a look at all kinds of different bonds. The previous slide was just the Treasury yield curve. This is all kinds of different bonds. And in general, you can see that the current yields, which is the blue diamond, is trading toward the higher end of the 10-year range of yields. We're down from these upper bounds here, but still well above the 10-year median ranges. And so this is why, the bond market is offering pretty good, very good yields. And we're happy to be owning some bonds in your portfolio in whatever proportion that we together, meeting with you privately, decide is the right amount. And you can see very, very healthy yields across almost all bonds. I'm not going to go into these individually. No need to do that. You get the point from the slide. Investment opportunities, CD rates, and other investments. Well, we had a lot of clients saying, I want to hold cash. We had quite a number of clients last year, especially earlier in the year, who were saying, well, look at what CDs are paying. And by the way, I want to warn everybody here because I'm not sure everybody understands this. When you see a quote on a CD, let's say you're seeing 5% on a 6-month CD. I want everybody to be clear. That 5% is an annual rate. I can't tell you how many clients have not understood that. They think they're getting paid 5% over 6 months. 6-month CD, it's a 5% 6-month CD. I'm getting paid 5%. You're not. You're only getting paid half, 2.5%, because CDs are quoted in annualized terms. A 30-day CD, a 5% 30-day CD. If you think you're going to get paid 5% for holding that CD for 30 days, I'm sorry to break it to you. You are not. You're going to get 1/12 of the 5%. Please, 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 please understand that. The banks and the bank marketers thrive on throwing these rates at you with those numbers. But in almost all cases, we can set you straight and get you into something that's frankly going to be right for you, including CDs. We have some clients who hold CDs. But please don't make that mistake. It is an annualized rate that you are being quoted. And so one of the big risks with CDs is reinvestment risk, right? When the 30 days is up or the 6 months are up, what interest rate are you facing if you have to reinvest the money? Now, what this slide is showing is that peak 6-month CD rates during previous rate hiking cycles and subsequent 12-month total returns. Boy, that's a mouthful, isn't it? So let me see if I can translate what it's saying. What this is saying is that when CD rates have peaked during a Federal Reserve rate hike cycle, which we have just been through, 2 years of a Federal Reserve rate hike cycle, and when CD rates have peaked, and they're showing you with this gray diamond what the peak rate was. So if we go back to 1984, the peak rate, look at that, 12% or so was the peak CD rate. And so you say back in 1984, June 1984 to June 1985, this period of the peak CD rate, which would have been the end of a rate hiking cycle, you say, give me CDs. Well, what was the opportunity cost? Well, bonds, not CDs, but just regular old bonds, a mix of the Bloomberg US aggregate treasuries and mortgage bonds and corporate bonds, had a 30% return. The S&P 500 had a 24% return. A 60-40 portfolio, a mix of both of these, had a 27% return. And so had you run into the CD, give me CDs, I just want CDs, right? The Fed's been raising these interest rates, and I just want everything in cash. Boy, look what you missed. And you see that in almost all of these periods. This is the sole one right here in 2000. And yet here, the bond market actually did quite well. So, this is the only one of these past 1, 2, 3, 4, 5, 6 prior rate hiking cycles before the current one. This is the only one where the other alternatives, the riskier alternatives, the stock market and the bond market, did not outperform cash. 6-month CDs, rather, which is kind of a proxy for cash. And in many cases, in most cases, almost in all cases, outperformed handily. And that's exactly what happened last year. So if you were happy with your 5%, that's great. But, stock markets did 15%, 20%, 25%. And so the turn in these rate hiking cycles, right? You can see the pattern. It's clear. When they're done raising rates and we reach the peak of the rates, assets rally in value. Okay, I think this may be the last slide, and then we'll turn to questions. Valuations by asset class. I think this is the last slide. We'll see. And you can see these are just different classes of assets, and current green dot is the current valuation based on a Z-score. That's a normalized statistical score based on 25-year average valuation measures for that class of assets. And you see US large companies and US growth companies and US high yield bonds all well above their 25-year average place, which would average valuation, which would be along this x-axis. Even value companies a bit above, not nearly as overvalued on the z-score basis as these growth areas. Small companies approximately fairly valued. Municipal bonds a little more favorably valued. And here you see international and international right here, both trading below their 25-year average valuation measures. U.S. core bonds and treasury bonds. So these areas right here are the undervalued areas of the market. These are the overvalued areas of the market. Oh, shoot. Economy. All right, let me do a few economy slides. This is inflation. You can see inflation has come way down here, right? This was this peak up here at 9%. Look at that. Headline inflation. Core inflation was much lower, around 7%, but still, you can see that we've come down from this inflationary peak, and this really is what the Fed has been looking at and making it act. Just wanted to show you that the change in the numbers shows up on the graph. Nominal and real interest rate, this interest rates and inflation. And so this is nominal yields on the 10-year Treasury bond. We're now at 4.14. We were up around 5% in October of last year. So that's come down actually quite a bit, but certainly way up from the 0.5% that it was yielding in August of 2020 during COVID. And you see that real yields, that is to say, the 10-year Treasury minus inflation has come up out of this trough. We had negative real yields for a while, where inflation was actually higher than the 10-year Treasury bond. And, whoever was buying that then, they're, not too happy. And so we're above break even on a real yield. Inflation right now in January 18th, a few days ago, is 3.9% is the annual past 12-month reading. 4.14. So you're earning a little bit of a real return net of inflation on the 10-year Treasury bond. Recession, are we going to head into a recession? You can see that most recent readings are more benign. We don't have any red. We have a little bit of orange here on household employment showing in December, but it's not screaming red. And a few months ago in September, industrial production gave a little flash in October, but by and large, you see that we're not seeing much in the way of recession readings. And we were right on that too. So all throughout last year, I really didn't think we were going to get a recession, even though we've had an inverted yield curve, which can indicate that we're going to see a recession. But employment is so strong right now, and economic activity so strong, I didn't think we're going to get a recession. We haven't gotten a recession. We could get a recession. It's possible. This is not telling you that we're not going to get a recession. It's just saying that the individual components that are watched by the NBER are not flashing recession. And then I think this is the final slide. What about the Fed? Oh no, I've got one more slide after this. The Fed, this is where we are here on the federal funds rate, 5.38%. The Fed, the Federal Open Market Committee, is this blue diamond, and they are estimating that they're going to bring the federal funds rate, the short-term rate, down to 4.6 and 3.6 and 2.9 over the next year to 2 years. But the market, look at the market, which is the aqua diamond, actually sees that the Fed is going to bring rates down lower and faster than what the Fed is estimating. And the market is often right about that. The market's often looking out. And so you can see that the Fed sees that by 2025, we would see rates around 3.3%. And this is what caused us last year to move quite a bit of our short-term bonds into longer-term bonds, because if we kept you all in short-term bonds and the short-term rate goes to 3%, you're not going to get this 5.38% forever. In fact, you may only get it for 1 or 2 more years, and then what? So it's this that's caused us to say, let's not get, what the saying is, pigs get fat, hogs get slaughtered. And we just wanted to get fat. We didn't want to get slaughtered with holding too much in short-term bonds. All right, this is the last slide, I promise. 2024 themes. The Fed, we're expecting the Fed to begin some easing. The market is too, but it's a maybe. They could surprise us. And we've had some stronger readings on inflation recently that could surprise us. So we could get some surprises from the Fed. I think more on the not easing side than on the easing side. Value continues. I've talked about it all over the presentation today. Value is cheaper and less expensive than growth right now. But you hold both. International, cheap, really cheap. But you hold both U.S. and international. Cash and cash equivalent yields are still robust. We continue to hold and give you really good dividends on large holdings in short-term cash equivalents. It's not like we're abandoning that area, and people are really happy with the big amount of dividends you're getting in your portfolios now. It's a pleasure to show you your performance report, and I mean, people are like, what? I'm getting all that dividends. Yeah, you're getting an enormous amount of dividends. It's funny because J.C. Smalley, my incredible colleague, is a young lady, and she has never seen interest paid in her career, right? She thought interest was just something you get 0.5% or 1%. I was like, well, no. In my lifetime, 5%, even 10%. I've seen 15% when I was a teenager. And so she's like, oh my gosh, look at the dividends that are getting paid to our clients. It's a wonderful thing for you savers to be getting paid quite a bit of return in the form of dividends. And of course, political and geopolitical risk and volatility here in 2024. We have political risk here in the United States, and we, of course, have geopolitical risk that continues in many places in the world, and most especially in the Ukraine, which continues to be an agonizing thing. And I wish it would stop, and I wish they had a new leader in Russia. And by the way, this presentation today is dedicated to the memory, of my professor, Stanley Rabinowitz, who passed away overnight. Was a remarkable man and will be missed. Taught me a lot about the world and how to think about the world. And of course, the agonizing war in Israel and Gaza. And I wrote a piece decrying violence when that war broke out, and I stand by it. Violence is no way to solve problems. Violence destroys capital, it destroys people, it destroys buildings, it destroys just about everything. And I stand against violence. So that is the presentation, and we will open it up to questions or comments.
Yeah, there's nothing so far. Okay, we just got one. Is MSCI from Morningstar?
No, MSCI stands for Morgan Stanley Capital International, but it is not any longer a division of Morgan Stanley. Many years ago, it was split off and became its own company, and it is actually the leading index provider in the world. Major company. There are other companies. Standard & Poor's, of course, has its indexes, and Morningstar has indexes. FTSE, the Financial Times in the UK, has indexes. So there are lots of index providers. Dimensional, that we work very closely with, has its own indexes. It just doesn't publish those indexes. It feels it has a competitive advantage if it makes its indexes, keeps its indexes, and invests its indexes. But they make indexes too. And so there are a lot of index providers. That's why I think the documentary will be very interesting to those who attend, because it really is a discussion about the birth of indexes and index funds. And it's a great story, an entertaining story. And we are living in the afterglow of those really extraordinary discoveries. And most people now understand that if we can keep our expenses low and track an index, we'll do just fine. in our investments and get good results. So that's MSCI. You can go to their website, and I mean, it's vast amount of indexes, and they specialize in global indexes, not US only indexes. I would say S&P is more focused on US only indexes. Morningstar is global, but they have a whole other area of their business, analyzing mutual funds. All of them successful companies. MSCI really is the power in global indexes.
Okay, we had
other questions.
Yeah, another question came in. It says, are bonds lesser risk or volatile instrument beyond CDs? Are they lesser than CDs?
It just depends. If it's a 6-month CD, but it's a 30-day bond, then I would say the 6-month CD is going to be more volatile. It doesn't mean you're not going to get your money back and your interest paid. It just means that your reinvestment risk when your money comes due is going to be greater, and the interest rate risk is going to be greater. So any kind of fixed income instrument, whether it's a CD or a bond or something else, the key question really is mostly, what is its duration? How long is the duration on the instrument? And a 6-month CD has 6 months of duration. A 30-day bond, or in the case of a money market fund, which is a 7-day bond, that's really what a money market fund is, a 7-day bond, is going to be less risk. It's going to be less risky. I'm not saying from a credit perspective, right? But from an interest rate perspective, it will be less risky. Now, from a credit perspective, we're talking about different things. And so CDs have certain insurance provisions through FDIC that a 7-day money market fund may not have. So it may be riskier from a credit perspective, but it may be less risky from an interest rate perspective. So it's an excellent question. And I'm sorry, it's a nuanced answer, but you see there's 2 measures of risk going on there with the fixed income instruments. Well, I want to thank everybody yet again for sharing their lunch hour with us. Again, reminders, if you want to attend the movie, Tune Out the Noise, please do register because, right, Catherine, you're not going to get in if you're not registered. They're going to have a list. I don't think anyone can just show up at the door. Is that right?
Yeah, I think that I would say strong preferences that you register ahead of time. It's an in-person event and, at the theater. So they want to definitely make sure they know how many people are coming. So if you want to reach out to me, you can email me or call me and I can make sure you get that registration link if you don't still have it in your inbox.
And if you haven't been, the iPic is a really fancy cinema. I mean, it's like these big plush seats, and it's in that really fancy center between Highland Village and the Galleria. And it's a fancy. I mean, I'm not a fancy guy, but I appreciate fancy, and so the cinema is really fancy and nice. I mean, really like a home theater seats, and they have waiters coming to serve you in your seat. They're going to have food. I don't usually go there because the tickets are like 3 times the regular tickets, and I'm not a fancy guy. But this one's on Dimensional, and so I'm going to go, and I'll look forward to seeing you there. So it's an entertaining documentary. The filmmaker Errol Morris is really a great filmmaker. And so you're not just getting a documentary that's about this topic of the early days and the birth of index funds and indexing, but you're having it shown to you by one of our really great storytellers, and there's a lot to say for that. Okay, anything else, Catherine Barr, that you can think of?
Nothing else came in.
Okay, well, thank you everybody, and have a great rest of your day. And we'll look forward to seeing you whenever we see you.
Thank you.